as we wait for this number here. We also are going to be looking at average hourly earnings and unemployment rate. So let's take a look at what we got. So waiting for that report here. Initially, S&P, NASDAQ, Russell up. Dollar index slightly up as well. Let's take a look at what we got. All right, 177K, guys. We got a good print here. Average hourly earnings went down, right? So that's a little bit of soft data for the hourly earnings. And then unemployment rate stayed the same. So how do we rate this? Well, overall, I would give this is a great point. This is actually also good for the inflation story, right? Labor data or average hourly earnings coming in a little bit soft means people getting a little bit less wage increases than forecasted. I know that's not great for the people who didn't get wage increases, but it is great for the inflation story, right? Because people getting wage increases is inflationary. So we see NFP came in real strong, very nice there. However, we did get a revision lower on the previous number, so some mixed there. Strong NFP report here, right? We were expecting 138K, so this was actually pretty good. I'd give this a B+. B+ overall in terms of a report card for what the market wanted to see, right? B+ to A even, pretty close. Nice solid number. We see a market reaction here. Gold down here on this number. We see dollar index up, stocks up, oil flat, and Bitcoin kind of flat as well. Not too big of a move in either direction. So let's break this down. What does this tell us? Well, it tells us that jobs data coming in here is not mission critical. Right? People have been so worried about like, oh, you know, tariffs are going to, all the CEOs of the world are going to stop, you know, all the CEOs of the world are going to stop hiring, and they're going to freeze hiring, and everything's going to, you know, HE double hockey sticks, and it's all over, right? People have been so scared of all the tariff stuff. But what we see in actuality is earnings and jobs this week, ready? They were good. Right? Despite the market freaking out, this is classic. This is classic market psychology. Everybody convinced market's going to crash. You know, companies are going to start laying people off in mass, and tariffs are going to drive inflation to the moon. And what do we have in actuality? This is where the hard data matters, guys. The hard data tells us jobs got added more so than expected. And what do we know about inflation? Inflation's down. Inflation's at 2.4%, right? PCE's at 2.6, PPI 2.7, CPI 2.4. All of the inflation readings are looking relatively okay. So context matters here, right? Because again, the market will tell you, the market has been telling you, oh my gosh, everything's going to crash. You know, Trump's going to ruin the world. And again, whether you like or dislike Trump's political views, this is where I say it doesn't really matter from a trading perspective. Leave that at the door. It will only do you harm if you trade with your politics in both directions. If you love Trump and you know, put your whole account into longs on calls on the S&P 500, it's been a painful year, right? If you hate Trump and you said it's going to crash and he's going to ruin everything, and I know it, and the market ripped, it hurts you, right? So leave your politics at the door. Please do yourself a favor. Otherwise, you're just going to really regret it. The main point is let's look at the data, right? What did data tell us today? Jobs look healthy enough, right? That will do. We launched the Edge Finder 3 years ago in April of 2022. And now, years later, the tool has helped thousands of traders take their fundamental analysis and sentiment analysis to the next level. Traders can track things like the commitment of traders data, which shows institutional money flow, whether they're buying or selling certain assets like gold and currencies and indices. Additionally, we've made economic heat maps that allow traders to track easily the fundamental or economic data trends that we're seeing in markets right now. You can also track retail positioning and see what the market sentiment on your favorite assets are right now to look for some contrarian signals. And of course, it strings it all together with the top setups algorithm showing traders the most convicted top ideas that the Edge Finder is producing now. The Edge Finder has helped traders go from beginner to pro in terms of the fundamentals and has helped many traders go from unprofitable to finding the missing pieces in the name Edge Finder. So if you're not already using the Edge Finder, let me tell you about the biggest discount that we offer all year long starting right now. The 3-year anniversary sale is going to be our biggest discount that we offer all year long, and it is now available to people who are watching right at this moment. Traders looking to get access to the Edge Finder can take advantage of this massive discount for a limited time using the link in the chat being dropped right now or in the description of this live stream. If you've been thinking about getting a copy of the Edge Finder, do not miss this opportunity. It is the lowest price that we do all year long, and it's a one-time payment to get access to the tool. So don't miss it. Celebrate 3 years with us by getting yourself a copy of the Edge Finder at the super discounted prices. Thanks for watching. And now back to the show. Russell's doing okay this morning. You've got dollar index lower here on this. Interesting. Look at what happened to the dollar. What's going on here? Dollar index, is that accompanied with yields? No. Okay, wait up. Hold on. Yields are up. Dollar is down. Let's break that down. What's going on here? Bonds lower here this morning. There must be some nuance in the report that I'm not picking up on immediately. Really interesting, though. So, again, let's recap what we had here. NFP was strong to a degree, and then you had a mix in the revisions. Unemployment rate stayed the same. Average hourly earnings went down. Or they didn't go down. Let me say that better. They went up, but at a much less pace than people thought. So let's just take a look here, see what the Fed tool is telling us now. So pretty much a 98.7%. And if we take a look at June, we are now slightly favored to actually hold interest rates steady in the June meeting. So what this tells you is that the first kind of easy answer of when a rate cut is likely to come by is July 30th of this year. So the July 30th meeting is expected to be the first time we actually get a rate cut. Now, June is a maybe. June's 50-50. July, according to the bond market, right? June is 50-50. May is pretty much off the table. July is the first time where we're like, okay, yeah, we'd probably get a rate cut by July. Pretty strong chance that we get a rate cut by July. But again, what I would say in response to this, right? People have been, really claiming that there's going to be a recession, that's happening. Well, the difficulty with trying to claim that there's going to be a recession is this does not scream recession. There are some weakness points to look at in the US data, don't get me wrong. But the NFP report is a big one, and it doesn't really suggest huge probability of a recession. At least not yet, right? And again, I study this stuff every single day, and I cannot tell you with certainty what it's going to do next, right? Nobody can. So when people tell you with certainty that a recession, like a lot of people are out there, they're like, oh, we are going into a recession. I'm very confident we're going into a recession. I mean, maybe we do, but it's going to be a very, people have tried time and time again to call the timing on recessions and been very wrong. Believe it or not, in April on the S&P 500 and the NASDAQ, we pretty much came back all the way to break even despite being down at one point for the NASDAQ upwards of 15% on the month, which is a crazy drop. It's been a wild turnaround, and I'm curious your thoughts on the indices. Are you bullish, bearish, cautious? What do you think?
Yeah, actually bullish, but not 100% because it's all about fundamental currently. But I think that sell-off was also a boost for new guys to buy some shares, because all these shares were actually affordable, or some stocks were actually affordable. So I think that it's actually a boost. And we slowly see Trump starting to cool off on the tariffs. Maybe one way or another, China and US, they will have to sit on the table. And it seems like it's going to happen, even though it might not really be now. And I think that is actually good for the stock market.
Yeah.
Another thing I saw, I think Trump and Prime Minister of Canada, I think they scheduled a meeting together. I think that will also soften the tariffs, and that is going to be good for the stock market. So I think we are going to see some reversals here and there.
Yeah, that's a great point. We are seeing, like you said, several kind of countries come to the table, want to negotiate with the United States, wanting to make deals. And I do think that there's also, both sides of that, right? The U.S. also backing off a little bit on the aggression towards China, maybe playing a little bit softer rather than just kind of threats and aggression. We're seeing a little bit more on the negotiation side, which I think is what the market ultimately was okay with, right? Tariffs, themselves are simply tools. Trade negotiation is not the end of the world. It's the way that the Trump administration kind of came out swinging first that really kind of scared the market. And now we're starting to see a little bit more of a slowdown of that process. And clearly the indices really like it. Now we're grinding higher here. And that big 90-day update, I've been talking about this a lot. That big 90-day pause announcement was this ginormous candle on the NASDAQ. And then the market kind of fizzled out and faded. But now that we've recaptured that area, that key level has actually become a floor of support. So I'm wondering, do you think that this market move has, from here, do you think it is possible or more likely that we see kind of just a continuous kind of very sharp retracement back to the highs? Or do you think that there are going to be some drops in the meantime? Do you think we'll see more pullbacks? And if so, how would you be looking to enter the market, since you mentioned you're leaning bullish but still cautious?
I think at the moment I will be way too cautious, because those resistance zones that you have marked there, they are very important. The only thing that it's pushing or stopping the market, I can say it's actually China and US. But one way or another, we see that they won't survive. Both of them, they won't survive these higher tariffs. So they will actually make that deal. And if that happens, I can say, yes, we're going to reach those 22,000 there. But at the moment, I think the market will be respecting every level. I think the market can reach the first, I think it's 2,400 there. The market might reach that, and maybe we might see a respect there before maybe we see a nice push. But if maybe we have a deal very quick, I don't think we're going to take much time to reach the highest level.
In terms of the overall market perspective, gold dropping is a good thing, right? It signals that maybe some of that peak fear, that certain uncertainty that we saw in markets is starting to relax a little bit. And as you mentioned, if you get Russia negotiating with the US further, and as you pointed out, US and Ukraine relations kind of intertwining more, back kind of aligned again, definitely means okay, Russia's now not just dealing with Ukraine and Europe, but they're dealing with everybody again. So it's okay, that is a more stability to the realm to some degree, and that brings gold lower, right? So just remember, to everybody in the audience, gold thrives on that uncertainty, war, fear, massive inflation, hyperinflation, economies crashing. These sorts of events make people run to gold, but just like people can run to gold, they can also dump it or get rid of it when things look a lot more stable. And I think that you are seeing some stability. So I actually had a gold long position. I traded this run up in gold prices and then ended up taking profits after we closed here. I entered again and then took a loss, a smaller loss here. So I'm no longer in gold, and I don't have a reading at this time to be long gold. Do you have any trades, Kenzo, on gold, or any ideas? Would you get long if it were to retrace further? Do you have any positions? Would you get short? What do you think?
Yeah, I actually have some positions on indices. Yeah, Nasdaq, S&P. On gold, I was actually scalping, and I can see that it's little bit struggling. And I think if it breaks that support, it means I will be out, because that was also a very nice area for a smaller support. But with the news that we start to hear, it seems like it's gonna be a little bit difficult for gold to reverse. But we'll just actually watch and see. But I can see it's like 1, 2, 3, or we can say almost a week where gold was actually struggling. Because if you check before that, it was moving very nice. After that, we start to see the struggle. Yeah, and if you check also VIX, we can see that the panic is starting to cool off. So that shows the confidence. And yeah, if you see gold VIX going down, I don't think it's a good thing to be holding gold for quite long.
That's a great point. Typically there is some overlap when you get a lot of fear in markets, that can equate, not always, but it can equate to rushing in of gold as kind of that alternate. And it really worked. The trade really worked, VIX long, gold long, recently, because there was a big sell the US trade. And that meant lower dollar, higher gold. It meant sell US treasuries and buy the alternative, to gold, to treasuries, which is gold. Oftentimes I mentioned that, like, TLT, which is a very popular bond ETF for stock or investors, they can buy the TLT, which is like US bonds, or they can buy gold. And there's times to buy each one of these. This is actually a favorite topic of mine, because with US bonds, right? With US bonds, you get something just for holding that, right, Kenzo? Like, we get paid if you buy a US bond, you're getting paid some amount. Like, let's say it's like 5% per year. Like, every year, just for having your money invested, you get 5%, and that's what you're going to get. And a lot of people in like retirement or funds that have billions of dollars, like, they'll just park some money here and collect that 5%. Now, why is gold an alternative to that? Well, gold doesn't yield anything. It yields 0%. However, it typically thrives in the same environment that bonds would thrive. Like, bonds go up a lot of the times in the same environments where gold goes up. When people are fearful, they rush to bonds. But the reason gold did so well recently in all this is because people actually said, we don't want US bonds because the US is kind of the question right now. So this being the comparable alternative got really attractive. Gold got like doubled up. That whole crowd that buys these combinations, like, they buy bonds, they buy gold, like the defensive crowd, the option for bonds was like not a choice. People went right into gold. So just something to think about. Kind of an interesting flood of capital into gold for that reason.
Yes, I think on US bonds, I can say it was politically motivated. It was not something that happens every day, because when things are not really going well, bonds are quite safe, because it's like loaning the government. One way or another, you're gonna get your money back. So, and it comes with a certain percentage, or let's say interest rate. So yeah, at the moment it was people, let's say politically, when we say Trump is doing some sketchy stuff, that gives investors doubt to say, why should we hold US bonds?
Yes.
Because it seems like they're gonna change their terms like every now and then, and that is not really a stable thing. Yeah, that's why I think after US yields went lower, I think Trump panicked and said, you know what, we're gonna pause tariffs for 90 days. And then they did bounce back. Because if you see bonds going down, it means there is someone who is selling. And most likely it's those countries, bigger countries, they also hold those bonds. Even people, they do that. But mostly you're gonna see a different with the governments. So if they sell, that is not really good, because it's like they're losing interest, or they no longer have confidence with that country. So, but now I think maybe slowly we saw smaller reversal. Maybe we'll see that continues over time. But for now, I think everything slowly is going to recover.
US data, not very impressive, to be quite honest with you. It's really not interesting. NFP was okay, 177, definitely beat forecast. Previous was revised down to 185k. So if we're comparing the actual to the previous, yeah, not great. The unemployment rate stayed the same at 4.2, which again isn't great. Average hourly earnings took a hit at 0.2 from 0.3, or sorry, the expected of 0.3 and the previous of 0.3. So again, yeah, not very impressive. But the dollar did rally off the initial reaction, and very quickly heading back to the downside, which really isn't a surprise, to be quite honest with you. I mean, the data wasn't anything special. The US dollar, however, faces the really strong monthly level right here. So it's, you know, still in my case, or sorry, in my view, it's still a big thing to just watch and see what happens here, because it looks like the dollar bulls tried to step in and they've not really had much success. But the really key thing is if we can close this monthly candle below the sort of 99, 100 psychological levels, that would be a big thing, because that means that the bulls can't hold on. With, you know, 100 isn't a light thing. That's a big level to just break through. And if the bulls can't hold on to that, then we're likely going to go and head down towards 95, 90, I would say. Bashi, ball out. Hello, Tiger, Panda 4X, Shells, Lee, good to see you all. So yeah, no change for me in terms of what's going on with the dollar. I'm still just waiting to see what happens with tariffs. Gold, I am considering actually a short. I'm not going to take this just yet, because the trend is still to the upside. This is still a higher low in my view compared to, or relative to, the previous low. But so far, the technical setup looks really strong. And I just don't have a justification to buy gold. I really don't see a reason to right now. We spoke about it yesterday, but if we look at what's going on, we've had a huge problem with trade fears. So obviously we saw investors going into gold. Then we've had the 90-day pause. Europe has, as last thing I heard, this might have changed, but last thing I heard, I think it was yesterday, Europe has already got a plan written up for the US for a trade deal. Seems like China is also on the table there as well, potentially. So there is that sort of fading out of the mix. So gold short's potential, like I said, I'm not going to take it yet. I'm just going to wait and see. But the idea is there. So it's something in the back pocket if I see it start to come into relevance. Gold 2 scenarios: either break of the high, or goes up to 3,400 and then one more drop down to the end of the year with a break over high seasonality. Fair enough, if that's what you see. Yeah, oil, I really don't see anything on oil at all, to be honest with you. I wouldn't want to buy oil. It's too low to sell, so I'm kind of just flat here. Absolutely nothing to do there. Let's see. As I said yesterday, I'm not really looking for anything new. We did take a look at pound yen this morning on my stream. The technical setup looks fine, and I don't mind the idea behind it. So again, as we were saying on yesterday's stream, the yen, the markets have seen, oops, that's not what I want. This is what I want. The markets have seen a change in sentiment. We've gone from pretty risk-off, quite strong risk-off sentiment to now being a little bit more risk-on, cautiously optimistic is how it's categorized at the moment, which in my view is going to lead to an outflow of yen, Swiss, and possibly an inflow into the dollar, but we'll see. So obviously we've got the pound, which is risk-on, we've got the yen risk-off. So if we're seeing that change in sentiment, we possibly could see yen continue to sell off. We could see buyers coming into the pound. We've got the short-term trend change here with the moving averages, and we have also got the fib level here. So I'm just going to wait and see what happens. I'll probably wait until Monday. I'm not looking to take a trade on Friday. I don't think there's really much of a reason to. The only real problem I see with pound yen is that the central banks are just too divergent or too diverged. I'm not really sure what the right word is there. But we've got the Bank of Japan that is still on a path to normalization. Although their statement was quite dovish previously, the long-term outlook is still hikes. The Bank of England is expected to cut on the next meeting. I think it's in 6 days is the next Bank of England. So we'll see. But there is obviously, we've got BOJ hiking and the Bank of England cutting. So not the best environment to buy pound yen, but if we see the opportunity, then I'll try and capitalize on it. Where was I had a fib here, but I can't remember where exactly I drew it from. I think it was here back when I entered it was. Okay, let me just put replay mode back on so I can show you why. Yeah. So the reason I bought euro dollar here is because yes, I think euro dollar is overvalued. I've been saying that. I've been very vocal that I don't think euro dollar should be worth what it is right now, but it is. And what can I do about that? Nothing. I can just trade what it is. So although I don't agree with it, I can't do anything about it. So I'll trade. So fib from low to high of this range. Obviously, we've got this 50% 618 golden zone on the fib. We had this H4 bullish candle close. So I was like, you know what? It looks okay. I'll take it. The dollar at the time was dropping, and it still is dropping, so it seems fine from a currency strength aspect. And if we look at the behavior that euro dollar displayed previously during this period, we had the range like we had here, then the pop to the upside. So I was looking for a very similar play with the range and the pop to the upside. Now, have we had that? Not really. We've actually kind of just stayed within this range, but we might still have it. So we'll see. But yeah, I am very mixed on euro dollar. I don't think there's enough to support the euro right now to warrant this type of trend. It's mainly driven by outflow of the dollar, inflow into the euro, because the euro is the next liquid asset from the dollar. So it makes sense that if investors are not wanting to hold dollar, but they're still wanting risk on, they will go to the euro. That's quite simple. So there is that. So that's why I'm long euro dollar.
We came up and filled this gap. This is the gap from April 2nd. I had this drawn on the charts this week. There was certainly a head fake with the GDP numbers on Wednesday when the market dumped about 2.2% and decided, that was just a little spot to buy the dip. So we came back up and filled this gap. We do have a gap down here. We do have a gap as well in here. But hey, look, if the market's going to keep humming along until this structure breaks, maybe a bit more aggressive on a trend line, I'd say we just let the melt up continue, shall we? If it's going to melt up. A couple things I want to bring your attention to. I would say I don't get super excited about where we are at. I do have a big question mark. I pulled this yesterday from Bloomberg, which I thought was interesting. Widest gap in sell side S&P 500 targets this century, which means from the year 2000 to now, nobody knows where the market's going to go, right? The gap between the highest and lowest year-end price targets. So forecasts, some say 7,000 plus, some say we're going to be down. Doesn't matter. Point is, it's the widest in history since, I guess the widest of the century. So for 24 years, where you could argue like 1990 to now is like the modern market. The left tail, right tail, the distribution is so wide right now. So what does this really mean? Nobody knows. Nobody knows where the market's going to go this year. I don't either. And it's okay to say that. For anybody that claims to know where the thing is going, they're full of crap. Like, look, I'd say the easiest way to make money this year is if we're pleasantly surprised to the upside, there's ways to make money, right? Like that's easy money. Okay. I have been grinding all year, money on hedges and protecting, having the courage to sell premium during a nasty downturn when the VIX was spiking up to 45, 55, and 60 when it peaked, and then riding some of those out for those 30 to 45 day windows, which a lot of these trades have been closed up for profit. I think last week I closed up over 130 trades for profit, and 10-year yields are freaking up. This is another reason the Fed probably doesn't want to cut too aggressively, is because yields are not cooperating. I mean, yields are up 3+%. Basis points wise, they're up about 16 basis points. Anyway, Fed funds rate. Okay, now overlay the SPX. We'll go new pane. Okay, so I'd have to see if I can go to like a monthly chart. There, it should be a little bit easier to see this now. Take a look and see how this has responded to these major Fed cuts. Fed cut cycle, market was down. Fed cut cycle, market was down. Fed cut cycle, market was down. You know, we did cut 100 basis points. Now, I understand that, you know, but we were way up here at like, you know, 4 to 5% cutting down to near zero. 4% cutting down to near zero. 2.5% cutting down to near zero. I know that we're not necessarily going all the way back down to zero. Maybe it's different this time. I just don't know how this, going back, you know, 20 plus years, has ever been a good sign for the market. So, you know, Trump urging every single day, Fed needs to cut rates, Fed needs to cut rates. Do they? Because history would show that it's probably not the best thing for the stock market. Because usually when the Fed is cutting rates, it's into economic weakness. It's into an economic slowdown. So, I don't know. I mean, I have my concerns. But I think if they stay, you know, true to May, they don't do anything next week. This is a 98.7% chance they just do nothing next week. I don't know if there's going to be pressure. All of a sudden, it's like the Fed's, you know, they're too late. They're Mr. Slow or whatever the hell Trump called them. I don't know. It was obviously super good etiquette to basically call the Fed chair a loser. But anyway, I think Powell's done as good as any. Whether you agree with the Fed or not, nobody's going to agree with the Fed. They're always going to be wrong. They're always going to be reactionary. But their job is to provide stability and liquidity, and they do. And, you know, coming into June, right now, there is a chance of a pause, right? This is all kind of shifted, which I think is really interesting. Here's probabilities. So they're looking at now shifting a May to June pause. This changed this week because it was a June, July, September, October, or either October, December cut this year for 4 cuts in 2025. This looks like a pause for May and June. I mean, why? I don't know. But maybe because we have tariff uncertainty hitting July onwards. But I would be buckled up for maybe a wild second half of the year. If the Fed does start to cut, I think that correlation is something we need to be aware of. So just throwing it out there like big picture. Okay, the market doesn't typically respond well to, let me get rid of this one here. The market doesn't typically go well with like aggressive cutting cycles. Usually we don't see that show up and be, you know, super bullish. So anyway, time will tell.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.